Hi, I'm Neethling and I manage the DCM Money Market Fund along with Pitfall Yun. Today I'd like to talk to you about fund performance and how we position the fund going into the last quarter of the year. So the fund was started in October 2013 and has been running for 3 years. The current yield on the fund is 5.7%, which is around 1% above the STEFI Call benchmark at 4.7%. I think it's important to mention that none of this additional yield has been earned by investing in lower quality companies or lower rated credits. 100% of the DCM Money Market Fund is invested in A-rated credits or better, and 90% of this exposure is to the top tier banks. Any exposure to corporate bonds or commercial paper needs to be approved by our internal credit committee, and currently this exposure sits at around 10% of the fund. So the main reason for outperformance of benchmarks at this point in time is due to the fact that the fund charges the lowest fees in the industry at 15 basis points exclusive of VAT. In terms of the maturity profile of the fund, we are currently managing duration at around 90 days. With the sell-off in bond markets between May and September, we were able to acquire attractively priced instruments of longer duration or longer maturity. In terms of the current weighting of the portfolio, we are sitting with 55% in floating rate instruments, with the balance in cash and fixed. So we think the fund is competitively positioned in the current interest rate cycle. We believe there is limited room for the SARB to adjust rates in the short term, given the fact that it needs to balance lower growth with higher inflation. Going forward, we will continue to prioritize capital preservation and will only look for yield in lower risk, higher rated credits. Thank you.